Are you tired of missing out on investment opportunities that could change your financial future? Get ready to discover the biggest investment opportunity in 40 years. This video will give you the inside scoop on the most lucrative investment opportunity of our time. All that just at price of a mere click on the subscribe button. What else do you wish for? Meet Howard Marks, the man who's considered a legend in the investment world and ready to share his wealth of knowledge with you. The sea change in investing. Howard Marks, a billionaire and highly respected investor, recently talked about a sea change in the stock market and economy that he believes is occurring. He stated that there have been 3 sea changes in his 53 years of investing, and we are in one of them now. According to Marks, a sea change is a major environmental transformation, a complete change in attitudes, etc. The first sea change was the fall of interest rates from 20% to zero between 1980 and 2020, which had a very positive effect. The second was the opening of investors' minds to what is called risk-return analysis, where investors intelligently take risks instead of avoiding them. This was a significant change in investing. Now, Marks believes that we may be on the doorstep of the third sea change. Since the central banks around the world and the Treasury took intense action to solve the global financial crisis in 2008 to 2009, we have been living in a highly stimulated, very positive, easy money environment for roughly 14 years. Many people may think the last 14 years were normal, but they were not. It was the best imaginable period for borrowers and asset owners, but this will not be the best thing in the future.
The sea change is basically a change from the extremely low interest rate climate of the last 14 years, I guess, for that, and the climate of declining interest rates of the last 40 years. Ever since the Fed stepped in to rescue the world in the global financial crisis, they've kept interest rates low. That's made it very easy to get money. It's made it easy to make money. I just think that conditions are going to be somewhat different in the years ahead.
And this is important because you talk about the two distinctions, and it's key to say, yes, we went very low on interest rates in a kind of an emergency mode after the great credit crisis, and we never really got back to normal. But they were declining ever since the last time we had a big inflation scare. And that declining, in some ways, would you not agree, kind of changed the mindset even more? Because when you expect things to keep going down, it changes the way you think about how you're going to price things and the risk you're taking.
Well, it changed the mindset. It also created very, very salutary conditions. You know, in 1980, I had a loan outstanding from the bank, and I got a slip from the bank saying the rate on your loan is now 22.25. 40 years later, I was able to borrow money at 2.25. So we have a decline of interest rates of 20 percentage points steadily over that period. And declining interest rates are very good for the economy. They stimulate it. They're very good for business. They make it easier to make money. They reduce the interest cost to businesses. They make it great for borrowers. They make it great for asset owners because assets become an asset with a given cash flow becomes more valuable when competing things like bonds decline in interest. So salutary across the board.
Understanding the relationship between interest rates and asset values. To truly appreciate Howard Marks' comments, you first have to understand the relationship between interest rates and asset values. Asset values are simply the things people own as investments, such as stocks, bonds, and real estate. The value of an asset is based on the cash it will generate for you as the owner, discounted back to the present day using an interest rate. While this may sound complicated, it's actually a straightforward equation and concept. Let's say you buy a stock that produces $20 a year in cash for you every year for 10 years. At the end of that 10 years, you can then sell the stock for $200. You know how much cash the stock will produce. So the last step is to determine the interest rate used to discount those cash flows back to the present day. You have to discount the cash flows because today's dollar will not be worth the same as a dollar 10 years from now. If you had to choose between receiving $1,000 today or $1,000 10 years from now, you would obviously want that money today. This is referred to as the time value of money in investing. For example, a 15% interest rate gives us a stock price of $150 per share. But as we decrease that interest rate, the stock price increases. Bringing the interest rate down to 6% gives us a stock price of $259 per share. Notice how the amount of cash the stock produces stays precisely the same. The only thing that changed was the interest rate, which was powerful enough to push our stock price up by 73%. This is what has been happening in the stock market and economy for the last 40 years. As interest rates have steadily declined, asset values have steadily increased, even if the cash flow generated by those assets remains the same. This is what Howard Marks is warning about. The easy money environment we've been experiencing is not the norm and won't continue forever. As an investor, it's important to keep this in mind and adjust your strategies accordingly.
Well, number one, most people equate risk with low-quality assets and safety with high-quality assets. And they still do. I mentioned the Nifty 50. High quality, people thought, there's an old saying, you can't get hurt buying IBM. And we documented you lost 80 to 90% of your money. On the other hand, what about low quality? Is that a source of risk? When I got started in high yield bonds back in '78, I looked up in Moody's, what does it mean to be single B? And Moody's defined a single B bond as follows, quote, fails to possess the characteristics of a desirable investment. In other words, low quality asset can't be a good investment. Well, is there no price at which a low quality asset becomes a good investment? If we went out after this session to the parking lot and I said to you, I'd like to sell you my car, would you like to buy it? And let's say you like my car and you have money and you need a car. Hopefully there's one question you would ask me before saying yes, and that's what's the price? And here Moody's was saying that a B-rated bond is a bad investment. Well, what about at 75 cents on the dollar? What about at 50? What about at 25? Is there no price? And so this is the kind of herd error that you can take advantage of. So risk is not quality. And, most people believe that as something is rising in price, that means that people think better of it, it's less risky. Well, I think that when something rises in price, it becomes more risky.
Impact of rising interest rates and inflation. Inflation has been soaring to levels not seen in over 40 years, and it's causing the Federal Reserve, the government body responsible for influencing interest rates, for taking action. They've raised interest rates at an unprecedented pace to tackle runaway inflation, which has had a massive impact on the stock market. In fact, 2022 was one of the worst years ever for the stock market, with an 18% fall, making it the 7th worst year in U.S. history. But why do rising interest rates cause such chaos in the stock market? It's all about supply and demand. As interest rates rise, demand decreases because it becomes more expensive for people and companies to borrow money. This means that companies may have to cut back on big projects, and the demand for goods and services may decrease, leading to deflation. However, the Federal Reserve is committed to raising interest rates until inflation normalizes, and this can hopefully cool down inflation. As the underlying causes of today's inflation abate, the Fed might lower the pace of its interest rate increases, but that doesn't mean that interest rates will return to zero. Instead, the new normal may be somewhere between the high interest rates of the 1980s and the 0% interest rates of the 2010s. How will this impact your personal financial situation? It is crucial to stay informed about the latest interest rate and inflation developments, as they can significantly impact your investments and borrowing decisions. Will the Federal Reserve be able to get inflation under control without raising interest rates to levels seen in the 1980s? Only time will tell. But one thing's for sure. The world of finance is constantly changing, and it's up to us to stay informed and adapt to the ever-evolving landscape.
Of course, we don't know the full impact of the low interest rates. We've never had them this low, certainly never had them this low this long. It encourages business in certain ways, and it makes it easier for consumers to buy, but it also has certain distorting effects. It encourages risk-taking in order to get good returns. It makes capital available for risky projects. So I would say that the outcome is mixed. Monetary and fiscal policy, well, in the States, of course, fiscal policy is very expansionary. We're running big deficits. Lord Keynes would say that we shouldn't be running big deficits in a time of prosperity, or certainly in the 11th year of an economic expansion. So we have the risk of overheating and inflation. And of course, monetary policy is expansive now too, with rate cuts having been made and perhaps more in the offing. I don't personally think that we should be stimulating in the 11th year of an expansion, but the market, I think, likes it.
Investment strategies for a changing economic landscape. Now that we got a handle on what's going on with inflation and interest rates, it's time to talk about how it affects us as investors. Fortunately, Howard Marks has provided valuable insights on how investors should approach this changing economic landscape. We've gone from the low return world of 2009 to 21 to a full return world, and it may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return. Targets lenders and bargain hunters face much better prospects in this changed environment than they did in 2009 to 21. And importantly, if you grant that the environment is and may continue to be very different from what it was over the last 13 years, and most of the last 40 years, it should follow that the investment strategies that worked best over those periods may not be the ones that outperform in the years ahead. That's the sea change I'm talking about. The statement that stands out is that the investment strategies that have been successful in the past may not necessarily be the most effective in the future. This leads us to the question, what should investors do differently in response to these changes? Before we share these excellent tips with you, remember to subscribe and turn on notifications so you get all of our upcoming videos. Co-founder of Oaktree Capital Management has some valuable advice for you. In a recent memo, he highlighted 3 key strategies you should employ in the current market conditions. Firstly, Mark suggests it's time to consider buying bonds instead of solely relying on stocks. For years, interest rates have been so low that investors have had no choice but to invest heavily in stocks to generate any sort of return. But that's no longer the case. The yield on a 10-year government bond has recently surpassed 4% for the first time in 15 years, offering investors an exciting opportunity to diversify their portfolio and reap the benefits of a higher return. Secondly, Marks advises investors to take less risk and still generate good returns. With interest rates at rock bottom, investors were turning to riskier investments like cryptocurrencies and meme stocks to try and make a profit. But with bond yields now increasing, there's no need to take on so much risk. By adjusting your portfolio to include a mix of stocks, bonds, private equity, and venture capital, you can achieve your investment goals without putting all your eggs in one basket. Lastly, Marks recommends building up your cash position, as there will be exciting investment opportunities over the next 12 to 24 months. With interest rates on the rise, holding cash is no longer a hindrance to your investment returns. Instead, it's an opportunity to pounce on great investment opportunities when they arise. So, there you have it. Folks, by taking these strategies on board, you'll be better equipped to navigate the ever-changing investment landscape and achieve your financial goals. So, what are you waiting for? It's time to take action and invest wisely. Comment your opinions in the comments section below. We'll catch you up in the next video. Until then, take care and keep hustling.